Welcome to PNJ Group training on the income statement and comprehensive income. This section lays the foundation, the key standards, the core components, and the presentation choices that shape how financial performance is communicated to the world. By the end of this section, you will be able to define why income statement structure matters, identify the governing standards, explain every component from revenues through comprehensive income, apply both presentation formats, and describe cutoff requirements. These are the building blocks every engagement depends on. Here is the key thing about income statement presentation. It is not just a formatting exercise. When an item is misclassified between operating and non-operating, it moves the operating margin, changes EBIT, and distorts return on equity. Analysts and valuation models weight operating income differently from non-operating gains. A misplaced line item is not a cosmetic error. It is a measurement error that flows into every ratio and every multiple built on top of it. 5 standards sit at the center of income statement accounting under U.S. GAAP. A SC 220 governs comprehensive income presentation and superseded the old SFA S 130. A SC 225 is the income statement standard, though most of its substantive guidance has migrated into a SC 220. A SC 200-520 handles discontinued operations. A SC 260 requires EPS disclosures for public entities, and a SC 700-4020 governs how tax expense is allocated across income categories within the same period. The income statement starts with revenues, inflows from the entity's central operations, recognized under a SC 606. The default is gross presentation unless specific netting criteria apply. From revenues, you subtract cost of goods sold. COGS flows from inventory accounting under a SC 330. What remains is gross profit. The surprising part is how much information sits in that single line. It tells you about pricing power and production efficiency before overhead, financing, or taxes enter the picture. Below gross profit sit operating expenses, SG&A, R&D, depreciation not embedded in COGS, and amortization. Subtract those and you reach operating income, also known as EBIT. This is core profitability before financing and taxes touch it. Then come non-operating items, interest expense, FX transaction gains and losses, investment results. Add or subtract those, apply income tax expense per a SC 740, and you arrive at net income. That is the bottom line. Most people assume net income tells the whole story. It does not. Under a SC 220, certain items bypass net income entirely and flow into OCI. These include unrealized gains and losses on a FS securities, foreign currency translation adjustments, pension actuarial changes, and cash flow hedge results. Add OCI to net income and you get comprehensive income. Watch out for this one. Large OCI balances accumulating in a OCI on the balance sheet can signal risks that the income statement alone obscures. This is where things get interesting. Unlike the balance sheet, which is a point-in-time snapshot, the income statement covers a period. It could be a quarter, 6 months, or a full fiscal year. SEC registrants typically present 2 or 3 years of comparative annual income statements. The heading must clearly state the period. And here is a practical warning the handbook makes explicit. Errors in period-end cutoff are among the most common audit findings. Always confirm reporting period dates before finalizing. The single-step format groups everything into 2 buckets, all revenues and gains up top, all expenses and losses below, and a single subtraction yields net income. Simple and clean. But here is the limitation that matters. No gross profit line. No operating income line. If you need to assess operating margin or compare EBIT across periods, the single-step format gives you nothing to work with directly. Adequate for simple entities, but insufficient for the analytical work most stakeholders require. The multi-step format delivers the subtotals that actually drive analysis: gross profit, operating income, income before taxes. Each subtotal lets stakeholders evaluate a different layer of the business independently. A SC 200-2010-40-51 requires operating income be displayed or disclosed on a full income statement. Even if a client prepares single-step internally, SEC registrants must present multi-step or separately disclose operating income. PNJ Group recommends multi-step for all engagement work. It is the professional standard, and it protects against misclassification going undetected. Let us bring this together. Income statement presentation is not just a formatting decision. It shapes every ratio and multiple that flows from the numbers. 5 U.S. GAAP standards govern the area. OCI items bypass net income, so comprehensive income is the full picture. The multi-step format is best practice because it delivers the subtotals that drive analysis. And cutoff accuracy is a foundational control. Always confirm your period dates. Thank you for completing this section on income statement foundations.